Well, I think people, they're always worried the market's going down, and it does, as I mentioned. And 2 years ago, they were saying 2024 was going to be a down year for the economy, and 25 is going to be a down year. I mean,
every year.
I think economists have predicted 33 of the last 11 recessions.
Yes.
And
with great certainty.
Yeah.
That is Peter Lynch, the man who turned $18 million into $14 billion and delivered 29% returns year after year while everyone else was getting crushed. He just revealed something about market crashes that changes everything. And the scariest part, the investors who think they're being smart and cautious. They're the ones who end up losing the most money. Lynch says the real disaster isn't the crash itself, it's something else. And if you can't pass his one-line test, the same test that made Barbra Streisand call him at 5 a.m. begging for help, you're already set up to fail. Here's what's truly terrifying. Right now you think you know how to protect yourself in a crash. You've read the articles, you know about diversification, stop losses, maybe even hedging. But Lynch says all of that is missing the point entirely. There is one rule, just one, that determines whether you'll be destroyed or whether you'll thrive when markets collapse. The difference between investors who lose a lot and investors who build fortunes in crashes, it comes down to a single question Lynch asks. But if you can't answer it correctly, you're already doomed when the next crash hits. Today, I'm going to show you Lynch's 2 breakthrough discoveries about surviving market meltdowns. First, the one rule that separates the winners from the losers. The rule that sounds too simple to matter until you realize it's everything. And second, why the very strategies you think will save you are actually guaranteed to destroy your wealth. Here's Lynch himself revealing what really determines your fate in a crash.
So the first category involves the risk of investing in stocks. You said the real key to making money in stocks is not to get scared out of them. Why is that the key to making money in stocks?
Well, more important to that is I have this expression, know what you own.
I was going to do that one later. I'll cross it off.
But that's it. That's the most important lesson.
Okay.
Because you'll get shaken out if the stock goes from 10 to 8. You don't know what they're doing. What are you going to do with it? And I was saying earlier, I got a call. I did an ad for Fidelity with Lily Tomlin. She's very close with Barbra Streisand. So I'm on vacation, my wife and 2 other couples. And my secretary, Paul Sullivan, says, Barbra Streisand's called 3 times. She'd really like to talk to you. And she's very nice. And, I said, sure, I got some time this afternoon. So I called her, she says, I own all these stocks, and I'm getting up at 5 a.m. and looking at this stuff. And she said, I never did drugs, I never did marijuana. I just can't sleep. What do? I says, tell me 5 things you own. She named 5 companies. I say, okay, what do they do? She didn't have any idea. He's an incredibly talented person. She had no idea what those companies did.
Right.
So what are you going to do if they go down 50%?
Yeah.
If you don't understand what you own, you're toast.
It sounds so obvious to hear you say it, but it's amazing. You talk about people spend more time researching a refrigerator they're going to buy than they do a stock they're going to invest part of their life savings.
People are very careful. They spend hours, get $50 off on an airplane flight. They look at everything.
Right.
And they'll put $10,000 in some crazy stock they heard on the bus. And they have no idea what they're doing. And somebody invented this awful term before I got in the business called play the market.
Play the market. You don't like that term.
That is sometimes a noun, there it's a verb. It's a very dangerous verb. Play the market is not what you do.
Okay.
You buy good companies and some work, and you have to know what they do.
Know what you own. That's Lynch's golden rule. If you don't understand what a company actually does, its story, you're toast when that stock drops. Ignorance is the fastest path to panic. If you can't explain in a few seconds how a company makes its money and why it's a good business, you probably shouldn't buy its stock. Because when the price falls from $10 to $8 or even $5, you won't know whether it's a temporary setback or terminal collapse. You'll just feel fear. Picture this. You spend days researching a $1,000 refrigerator, reading reviews and comparing features to save maybe $50. But then you hear a hot stock tip at a barbecue and throw $10,000 into that stock without knowing if they make widgets or Wi-Fi routers. Lynch says people do this all the time. They play the market like a casino, betting on companies they know nothing about. When those shares tumble, they panic sell because that stock was a black box to them. That's exactly what happened with Lynch's anxious caller. Yes, that really was Barbara Streisand. She owned stocks but had no idea what those companies did, leaving her sleepless at 5 a.m., terrified of every headline. If you invest blind, any market tremor feels like an earthquake. Say you bought a stock at $10 without understanding the business. The price now drops to $5, a 50% plunge. You freak out and sell. Now you've locked in a massive loss. To get back to where you started, you'd need that $5 to double back to $10, a 100% gain. How often do you catch a 100% gain after jumping ship? Almost never. Meanwhile, if you knew what the company did and believed in its long-term story, you might have held on or even bought more at that bargain price. When the stock rebounds to $10, you'd be whole. Any rise beyond that is profit. The difference: knowledge and conviction versus fear and capitulation. Here's a story that drives this home. Imagine Tom inherits a farm but never visits it. One season his neighbor calls saying the fields look dead, nothing but dirt. Tom panics and sells for half the price, thinking the land is worthless. But if Tom had known it was a wheat farm, he'd know fields look barren between planting and harvest. The buyer who understood farming made a fortune at harvest time while Tom lost everything to ignorance. The same goes with stocks. If you understand a company, you can gauge whether a drop is temporary bad weather or permanent drought. For you as an investor, start prepping for the next crash now by auditing your portfolio. Can you briefly explain what each company does and why you believe in it? If not, consider pausing new purchases until you do your homework. You don't need a PhD in finance, but you do need to understand the story behind the stock. Maybe you work in tech and understand how NVIDIA dominates AI chips. Maybe you notice Starbucks is as busy as ever, even though prices just increased by 15%. That insight is your armor in a downturn. When stocks slide, you can think, sales are down this quarter, but people still line up for their products. This drop might be temporary. You won't scare as easily. If a stock dives and your reaction is, what do they even do? That's signal number one that you're unprepared. Either learn more about that company or trim it and focus on businesses you grasp. Your future self will thank you. Speaking of knowing what you own, that's exactly why we created Investor Center Research. Our team of investment professionals spend 40+ hours researching each company, so you get the deep analysis without sacrificing your evenings to earnings calls. Each month, we deliver one high-conviction research report on a quality business with durable moats and strong fundamentals. Right now, we're running discounts on all memberships. If you sign up today, you'll get instant access to our archive of 6 full research reports. Try it risk-free with our 30-day guarantee by heading to the link in the description or scanning the QR code on screen. Now back to Lynch. So we've handled one half of crash preparation, knowing what you own so fear won't shake you out. But what about the temptation to avoid the pain altogether? Many people think they can sidestep losses by predicting the crash and getting out early. Lynch has strong words about that idea.
You said far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Talk about that.
Well, I think people, they're always worried the market's going down, and it does, as I mentioned. And 2 years ago, they were saying 2024 was going to be a down year for the economy, and 25 is going to be a down year. I mean,
Every year.
I think economists have predicted 33 of the last 11 recessions.
Yes.
And
With great certainty.
yeah,
I might add.
yeah. And I think people they're basically, you look dumb in this business. You're terrific in this business. You write 6.5 times out of 10.
Yeah.
That's a great score.
Yeah.
Even if you write 5 times out of 10, if you own Costco or Walmart or I can't even pronounce NVIDIA. I'm getting close to being able to pronounce it.
I think you nailed it just there.
But that offsets your mistakes.
Yeah.
You have to have these winners offset mistakes, and that's what we've done for 70 years at Fidelity.
So you've got 2 more on this topic. I'll read them both. You said you get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready, you won't do well in markets. You also said people who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. How important is it for the average, I hate the term average investor, for the typical investor to go into this business understanding there's no way to dance around these things. They're going to take place. You're gonna have to live through them. Would you say that's one of the paramount things? Because that's what I think.
Well, the point is, what if somebody has 3 children about to start college in 2 years? They shouldn't be in the stock market.
That's right.
They should be in the money market fund. But it depends. If you got your house, paid down your mortgage, then you can invest. And it's been a great place to be since, year 1900.
Lynch's point is crystal clear. More money is lost preparing for crashes or trying to predict them than from the crashes themselves. The real danger isn't the market swings. It's the investor's own missteps trying to outsmart those swings. Why? Because no one can reliably time the market. Corrections and recessions will come, but they don't run on a schedule. As Lynch quipped, economists predicted 33 of the last 11 recessions. Experts cry wolf way more than wolves appear. If you dump stocks every time someone forecasts a crash, you'll sit out on many healthy rallies. Here's evidence. JP Morgan found that 7 of the 10 highest return days in the stock market often occur within 2 weeks of the worst 10 days. The market's biggest rebounds happen right in the middle of doom and gloom. If you sell after a big drop, you'll likely miss those sharp rebounds. Missing even top 10 days can cut your overall returns by almost half. Picture this. Tom and Jerry, both 30 years old in 1995, each with $100,000 saved for retirement. Both choose stocks, but here's where their paths split. Jeremy, he invests and walks away. Doesn't check the market, doesn't touch a thing, set it and forget it. Tom plays it, quote, smart. Every time the market feels toppy, he jumps to cash. Every crash, he waits for the perfect re-entry point. The problem? His fear keeps him on the sidelines during those explosive recovery days, missing just the 10 best days each year. Fast forward to age 60. Tom's account, $500,000. Not bad, right? Jeremy's account, $1.6 million. Same starting point, same market. But Jeremy has 3 times more money. Why? Because the best days in the market often come right after the worst ones. And when you're sitting in cash waiting for the all-clear signal, you miss them. That's the brutal math of market timing. Remember March 2020? While everyone was hoarding toilet paper and doom-scrolling bad news, the S&P 500 crashed 34% in 33 days. Fastest bear market ever. Trading floors went from buzzing to silent, like a stadium after the home team loses in overtime. Many investors bailed near the bottom, certain this was the big one. But by year-end, the S&P had recovered and closed up over 16%, hitting new record highs. It was the shortest bear market in history, only 23 trading days, followed by one of the fastest recoveries. If you sold in late March 2020 after a 30% loss, planning to wait for a better time, you'd have locked in that loss and missed the whiplash rebound beginning in April. Even returning months later, you'd have bought at higher prices and missed huge upside. The point isn't that you should never sell or blindly hold through everything. It's that trying to predict and sidestep every dip is a loser's game for most of us. Even Lynch says he can't do it, and he is a legend. Instead, the real preparation is psychological. Assume crashes will happen periodically and make sure you're okay riding them out. The U.S. stock market has had a 10% correction about 2 out of every 3 years on average, and a bear market roughly every 4 to 6 years. It's normal. This volatility is the price of admission for the higher returns stocks deliver long term. What can you do practically? First, check your need for cash. Signal number 2 that Lynch mentioned. If you have money you absolutely need in the next couple of years, college tuition, house down payment, that money has no business being in stocks. If a crash hits at the wrong time, you won't have the luxury to wait for recovery. Keep short-term needs in safe assets. Your long-term investments can remain long-term. Second, build a portfolio of high-quality businesses you genuinely believe in. If you know Company X has a strong balance sheet, loyal customers, and a history of weathering tough times, you'll view a crash as a temporary markdown rather than the end of the world. Some investors keep a shopping list of stocks to buy if prices plunge, but you can only do that confidently if you've done the homework. Don't obsess over being right every time. Lynch admits that even for pros, betting .600, 6 picks out of 10 being winners, is fantastic. You might only be right half the time, but if you let winners run, they can more than offset losers. Owning a Costco or Nvidia that doubles or triples can cover many mistakes. But you'll never get those multi-year winners if you sell during every market wobble or when the bull is halfway through a run. The investors who held Amazon through its 50% drops over 2 decades saw it multiply their money almost 450 times. One $10,000 investment became almost $4.5 million. The ones who sold at the first 20% dip made a little or lost a little. As Lynch put it, the real key to making money in stocks is not to get scared out of them. Prepare yourself mentally. A 20 or 30% portfolio drop will feel like watching your year's salary evaporate on a screen. Your stomach drops, hands sweat, brain screams, do something. But it's happened before and will happen again. If you've built your financial plan correctly, that drop is a setback, not a permanent loss. You haven't actually lost until you sell. Companies don't go to zero just because the overall market is tanking. History shows that after nearly every decline, markets have rebounded to new highs. Since 1974, after every correction, the S&P 500's average return over the next year was about 24%. After true bear markets, rebounds were even stronger. Bull markets tend to last much longer than bear markets. The odds favor you if you stay in the game. To synthesize Lynch's crash survival kit, own what you know. That knowledge gives you courage to hold or buy more when others freak out. Don't try to be a fortune teller. Except you can't dodge every downturn, so keep a long-term view and stay invested. Match investments to your needs. Don't risk what you can't afford to lose short-term. Do risk what you can afford for long-term growth. Do these and you won't need a crystal ball or nerves of steel. You'll have a plan and understanding that carry you through. When the next crash comes, and it will, you'll remember Lynch's wisdom and say, I was ready for this. Instead of scrambling, you might find yourself calmly looking for opportunities amid chaos, knowing the difference between a price drop and a real loss.